We had Bill Dudley, the former Fed official, Bill Dudley from the New York Fed. He was on yesterday saying that he thinks the equity market has it wrong, that the Fed is going to have to do a lot more tightening. You're going to take the other side of that. It's a tricky thing to fight the Fed.
It is, but yeah, I'm going to take the other side of that. I think that we will have maybe 100 basis points left. I mean, perhaps 50, 25, 25. I think you look at forward-looking sensitive prices, they are not going up. The only thing that's going up is going to be wages in certain sectors. Take a look at the housing industry, which was a major inflationary force in the last 2 years. The NAHB index, which was reported just a few days ago, I just looked at it. It has had the biggest drop in 6 months in its history. Only during the pandemic year, month of March 2020 to April 2020, did we have a bigger drop. If you go on the ground with real estate brokers, they say prices are softening everywhere. And remember, housing is 40% of the core index. Now, will you see that in the official statistics? No, because of the way the government does the official statistics, they put it in very lagged. So you're going to see housing prices continue to rise there. But on the ground, they're not. On the ground, the sensitive commodities, the real prices are not rising. And I think if the Fed takes a look at that, they will not have to go more aggressively. So I think the market has it right here. I think the June is going to be a bottom. And I think the second half of the year is going to be quite good.
So basically, you think it's time to declare mission accomplished?
I would say, well, I don't forgive the Fed for overdoing stimulus, providing the government with all the money that they wanted, which is way too much in 2020, 21. But if you take a look at the money supply, which is what I do, very often, they brought that to a screeching halt. I mean, we've had virtually no increase in money in 2022. And, my feeling is, I actually voiced if they continue this tight, they would produce a recession. If they begin to loosen a little bit, I mean, not loosen in terms of rates, because that's built in, but not keep that money supply, the biggest slowdown that we have ever seen, begin to raise it a little bit, I think we might get that soft landing that everyone else thought was impossible. Not a sure thing, but I'm becoming more optimistic about that.
What do you think the odds are, Jeremy, that the Fed is listening and would go along with what you're suggesting?
I hope they listen to everybody. And I really hope that they realize, again, their past mistakes of money too loose. And now they say, we don't want to make it just too tight. One has to realize, that the so-called natural rate of interest, people like Larry Summers who said, we have to go way above 2.5%. We have to go to 4, 5, 6. My studies have shown that really interest rates have fallen the last 20 years around the world, and we're already above neutral in terms of that. So if we go to 5%, we're going to absolutely have a very inverted curve and definitely guarantee a recession. So they have to be cognizant that they're 2.5%, which is their long-term Fed funds rate, under a 2% inflation forward scenario, is really too high. It should really be about 1.5%.
We're about out of time, but very quickly, you think that we have bottomed, that the June low was the bottom for the market, unless the Fed puts us into a recession?
Yes, unless the Fed, keeps on saying, oh, my goodness, we're getting CPIs that are just too high, continue to raise. Again, we need some raising there. I'm not saying stop now, but if they take a very aggressive 75, 50, 50 to, movement up to 4.5%, I think they're gonna be sorry that they've been so tight.